Right now, while most people are watching the price of silver celebrate its historic run up over a 144% in 2025 alone, crossing $100 an ounce in early 2026, making millionaires out of people who were laughed at just a few years ago, there is a hidden layer to this story that almost nobody is talking about, and it directly affects whether you can actually access your silver when the moment comes that you need it most. Because here is the ugly truth that the financial system does not want you walking around knowing not all silver is created equal. And the type of silver you hold could determine whether you are wealthy or whether you are holding a piece of paper that says you are wealthy, which in a crisis are two very, very different things. Let's start with what's actually happening in the market right now, because the data tells a story that should make every person with any silver exposure sit up straight and pay full attention. The silver lease rate, that's the rate institutions pay just to borrow physical silver, sat at a completely normal 0.3% for years. By January 2026, that rate had exploded to approximately 8%. 8%? You know what that tells you? That is the market screaming that there is not enough real physical hold it in your hand silver available. When someone is willing to pay 8% annualized just to borrow silver so they can guarantee delivery, that is not a paper problem, that is a physical scarcity problem. And that distinction is everything. Now, here is what very few silver holders understand, and this is the rule that could literally freeze your money. There are two markets for silver operating right now, a paper market and a physical market. And for decades, those two markets have been deeply intertwined with over 300 paper claims written against every single ounce of eligible physical silver. 300 to 1. That is not a typo. Jeffrey Christian of CPM Group, one of the most respected voices in precious metals analysis, has testified that silver's paper to physical ratio is, and I am quoting directly, 3 times as bad as gold's leverage. Think about what that means. If every holder of a paper silver claim showed up and said, I want my metal, the system could not deliver. It is mathematically impossible. And what happens when the system cannot deliver? They change the rules. They always change the rules. We have already seen this play out in history, and the pattern is being repeated right now. In 1980, when the Hunt brothers were running up silver prices, the CME, then COMEX, implemented what became known as Silver Rule 7. Overnight, they raised margin requirements so dramatically that it forced the Hunt brothers to liquidate their massive silver holdings, and silver collapsed 50% in a single event that became known forever as Silver Thursday. The exchange literally changed the rules while the game was being played. And in December 2025, that exact same playbook came out again. CME Advisory number 25393, released on December 26, 2025, raised initial margins for March 2026 silver futures to $25,000 per contract, a 13.6% increase from the previous $22,000. And that was the second margin hike in less than 14 days. The price of silver, which had been charging, dropped immediately. Silver peaked at $64.66 per ounce and then was hit with over 67 million ounces of paper contracts unwound within minutes. Millions of retail holders, not the big institutions with deep pockets, not the hedge funds, but regular people were flushed out. The rule change did what it was designed to do. It protected the paper system at the expense of the individual. But here is where I really need you to pay attention, because this is the part of the story that goes beyond the futures market and hits people who thought they were completely safe. In October 2025, something remarkable happened across multiple countries simultaneously. 5 major Indian mutual fund houses, Kotak, UTI, SBI, Tata, and ICCI Prudential, announced the suspension of fresh investments into their silver ETF funds of funds. Suspended, frozen, you could not get in. The reason given was a physical silver shortage in the domestic market, with local silver prices trading at a premium of 5 to 12% over international rates. The fund houses literally could not acquire physical silver at fair prices to back new units. Kodak documented that their domestic silver premium jumped from 0.51% on September 4th to 5.7% by October 9th, a more than tenfold jump in a single month. Those funds were locked. Money that investors wanted to deploy into silver was frozen at the gate. Now ask yourself, if the entry can be frozen, what does that tell you about the risk that the exit could be complicated under the right conditions? Because what we are watching is not an anomaly. This is the system showing you its cracks in real time. These are dress rehearsals. The ETF structure for silver requires physical metal to create new units. When physical silver is scarce, when premiums go parabolic, when supply chains tighten, the paper wrapper around silver breaks down. The fund cannot source the metal, the premium blows out, and the fund house makes the decision that protects the integrity of the fund at the expense of your ability to freely move your money. This happened in one of the world's largest democracies with some of its most regulated financial institutions, and it will happen again. Let's look at what is happening at COMEX right now, because this is where the real existential question for paper silver lies. As of early 2026, COMEX had approximately 103 million ounces of registered silver, the silver that is actually available for delivery, against open interest approaching 429 million ounces. If even 25% of contract holders stood for physical delivery, which is not extreme or unusual, the math does not work. The silver is not there. COMEX's own rulebook gives the exchange extensive authority to modify contract terms, delivery procedures, and settlement mechanisms during market stress. That means when push comes to shove, they can cash settle your contract. They can hand you dollars instead of metal. And if you hold paper silver, an ETF, a futures position, an allocated account that you have never verified, a certificate, and they force cash settlement, you do not get silver. You get the price of silver in dollars at the exact moment the system decides to pay you out, which is almost certainly not the moment that is most advantageous to you. The LBMA in London paints the exact same picture. Their eligible silver stocks had shrunk to approximately 155 million ounces by 2025, while floating annual demand was running at somewhere between 900 million and 1.2 billion ounces. The market was already in deficit for 5 consecutive years between 2021 and 2025, with cumulative shortfalls estimated at roughly 820 million ounces, nearly equivalent to an entire year of global mine production. And mine production is not going to bail anyone out, because global silver mine output actually peaked in 2016 at 900 million ounces and dropped to roughly 835 million ounces by 2025, even as prices more than doubled. The ore grades at the world's 12 largest primary silver mines have fallen by 36% over the past decade. You have to process 1.5 times as much rock to get the same silver. The supply side is constrained structurally and permanently, and the demand side, driven by solar panels, electric vehicles, 5G infrastructure, data centers, nuclear reactors, and defense electronics, is inelastic. Industrial users will pay whatever they must pay for silver, because without it, their products cannot function. By 2025, industrial demand alone reached 680 million ounces, representing about 60% of total demand. So what is the rule most silver holders do not know? It is the cash settlement rule. It is the margin hike rule. It is the subscription suspension rule. It is the legal framework that allows the exchange, the fund house, the bank, the government to step between you and your silver when the system is under stress. Every single one of these rules exists. Every single one of these rules has been used. Every single one of these rules protects the system, not you. The IRS compounds this further. Under Internal Revenue Code Section 408 MEM, physical silver is classified as a collectible. That means when you sell at a profit, you do not pay the standard long-term capital gains rate of 15% or 20%. You pay a maximum federal rate of 28%. Short-term gains, taxed at your ordinary income rate, and state taxes on top of that in many states. So even in the best case scenario where you hold physical silver, gain enormously, and sell successfully, the tax system is designed to take a larger slice than it would from your stock portfolio. This is not conspiracy, it is tax code. Section 408M, look it up. Here is the backwardation signal that should tell you everything. In normal markets, silver futures that expire further in the future trade at a slight premium to near-term contracts because there are storage costs, insurance, and financing costs built in. Starting in late 2025, the silver futures curve flipped into backwardation. Nearby contracts became more expensive than deferred contracts. That is the market saying loudly and clearly, silver you can take delivery of today is worth more than silver promised in 3 months because we are not sure there will be enough silver in 3 months to deliver. When a futures market goes into deep backwardation, it is a physical scarcity alarm going off at full volume. The market doesn't trust that delivery will occur, and when the market doesn't trust delivery, the paper price and the physical price begin to diverge. We already saw a nearly $5 per ounce arbitrage gap open between the COMEX paper price and the physical price in Asian markets in late 2025. That gap will widen. It always widens when paper finally confronts physical reality. Samsung, one of the most sophisticated technology procurement operations on the planet, saw all of this coming. In October 2025, Samsung C&T finalized a mining prepayment deal directly with Canada's Silverstorm Mining to restart the La Paria silver mine in Mexico and secured the exclusive right to purchase 100% of the mine's silver output for 2 years. They did not go to COMEX, they did not buy an ETF, they did not trust a paper receipt. They went directly to the source and locked up the physical metal before anyone else could get to it. If one of the world's largest industrial companies is bypassing the exchanges entirely to guarantee its own supply of physical silver, you have to ask yourself what they know that the average retail investor is still catching up to. China's export licensing restrictions on refined silver, which took effect January 1st, 2026, removed a significant source of above-ground supply from the global market. China has been one of the world's largest producers and refiners of silver. By requiring export licenses, effectively restricting the flow of silver out of the country to protect domestic industrial demand for solar, electronics, and EVs, China made explicit what the data had been showing implicitly for years. Physical silver is now a strategic resource, and strategic resources get hoarded, restricted, and weaponized by nations before they get shared freely on an open market. Russia demonstrated the exact same logic from a different angle. Under Western sanctions, Russian central bank assets, including gold reserves held abroad, were frozen. Geopolitical reality forced a reassessment of what it means to hold an asset in a safe place versus holding a paper claim on an asset. By early 2026, Russia began exploring silver as a reserve asset specifically because of its industrial demand characteristics and its monetary properties combined. When central banks start treating silver as a strategic reserve alongside gold, the supply available for everyone else shrinks even further. So what does all of this mean for you, the person watching this right now, the person who either owns silver or is thinking about it? It means the single most important question is not the price of silver. The price of silver is doing what those who understood this were always told it would do. The question is, what form of silver do you hold, and can you actually access it when you need it most? An ETF can freeze your entry and potentially your exit. A futures contract can be cash settled without your consent. A certificate can be backed by silver that no longer exists or that has been lent out 300 times over. An allocated account at a bank can be complicated by bail-in legislation and counterparty risk. These are not hypothetical risks. These are documented real events that have already happened in this market cycle. They are not the exception. They are the built-in architecture of a system that was designed to keep you participating in the paper game while the real metal sits somewhere else. Physical silver in your direct possession, where you control the storage, where there is no counterparty, where no fund house or exchange can suspend, freeze, or cash settle your position, is the only form of silver that behaves like silver is supposed to behave in a crisis. It is not perfect. It has storage costs. It has tax implications when you sell. It is not as liquid in large quantities as pressing a button on a brokerage app, but it is yours. And in a world where a single CME advisory notice issued on the day after Christmas can collapse the paper price in minutes, in a world where 5 of India's largest mutual fund houses can simultaneously freeze your access to new silver investments, in a world where the futures curve itself is telling you that the market doesn't trust future delivery, the difference between having metal and having a paper claim on metal is the difference that matters when everything else is breaking down. The rule most silver holders don't know is that the rules can change at any time by any institution for any reason that protects the system. The only thing that cannot be changed, rewritten, margin hiked, cash settled, suspended, or frozen is silver you are physically holding in your hand. Everything else is a promise. And in the history of monetary systems, promises are exactly what get broken first. Do your homework, verify what you own, know whether you hold allocated, unallocated, or physically segregated silver. Know whether your ETF is a grantor trust or a fund of funds. Know your tax treatment and your exit strategy. Know what happens to your position if the exchange declares force majeure. These are not paranoid questions. These are the questions that people who kept their wealth through every previous monetary transition asked before the transition happened, not after. The clock is already running.